Hello and welcome to Hot Money on Bloomberg Quint Live. Maybe I overshot myself. This is India's first digital live streaming business news service, and this is a show. Hot Money is the show which gets you a complete wrap of all the stocks buzzing in trade. I'm Neeraj Shah filling up for Darshan Mehta, and let's welcome our experts on the show. Senthil Manikandan of Newberry Capitals to my right, Foram Parekh of Indiabulls Ventures to my left, and Sameer Kalra of Target Investing further to my left. All of them join us on the show to talk about 3 or 4 key topics of interest. Today on Hot Money, we'll discuss, firstly, the first discussion is about whether it's time to switch from ICICI and Axis, essentially the corporate-facing banks, to an HDFC bank or the retail-focused banks. Then we find out from our analysts what's causing the rally in Just Dial. It did take me by surprise yesterday, but we ask our experts as to why this is happening. Then we talk about whether it's the right time to buy defense PSU stocks. I wonder if any time is the right time. And then we discuss mid-cap stocks that make an attractive investment bet. So if indeed mid-caps are going to go up and about, then our experts should be able to tell us one stock, each of them, which will do really well. So, well, that is the most interesting part. But hey, let's start with the first discussion, which is try and put our analysts on the dock about whether they would take a bet of moving out from a stock like ICICI Bank or an Axis Bank to HDFC Bank. Ladies first, Foram, let me start off with you. What would you recommend?
Yeah, so I would recommend HDFC Bank, because if we see the entire bank nifty rally, the contributors have been Axis Bank and ICICI Bank. So of course we all know they did not participate for a very long time, and now results and everything is improving. But then I would always want to go for a stable kind of a stock. I mean, the power of 20 what HDFC Bank always has, be it in the loan book growth or the CASA ratio, everywhere. If we even look at the NPAs have been stable all over the time, and that is why I would always go for a stability over a pickup or a turnaround. I think Axis, ICICI both have seen a very fair amount of rally, and in this rally HDFC Bank did not participate at all. So I think now the time is for HDFC Bank. Though valuations are very expensive, and I feel it deserves a premium valuations because of the stability it has maintained, and that is why I would go for HDFC Bank, Kotak Mahindra Bank for that matter, over Axis Bank and ICICI Bank.
Okay, we'll come back to this thought. Sameer, the moot question though would be, is it time to switch? So if you have an Axis and ICICI Bank in your portfolio, would you go as far as taking capital, and assuming you don't have fresh capital, would you sell those stocks and put that money into HDFC Bank?
So not the full way, but I'll start switching. If I've already invested in Axis especially, so we had invested at the lower ends of Axis and before the rally started up, and now what has happened in both the rally is on the basis that new management is there. Couple of quarters will see good better provisioning, and the asset quality will improve. The loan growth will kick in. So all these factors for the next couple of quarters are already there in the valuation. So now it only gives the risk to downside. Any kind of a disappointment or any kind of a lag against the estimates will bring it down in a quicker way. If you see HDFC has been always a good performer. Consistency has been there, the forecasting has been there, right? So it's on the safer side. The valuations have been on the higher side for quite some time now, and I think because ICICI and Axis have got a premium valuation now, it's high time HDFC gets a slight bump. It might not be like 30-40% kind of a bump, but at least from here a 15-20% kind of a bump I see in next 1 year.
Okay, Senthil, would you play contrarian to these two? And the question and the reason why I say this is because almost every noted investor that we've spoken to in the last 6 months has said that with credit costs coming off, NPAs reducing, the beta in the corporate-facing banks would be much higher in FY20. That alone should provide a lot of metal to these names. Why should somebody switch from that pocket to an HDFC Bank, which is premium valuation, where FIs almost have near about peak holding any which ways, and therefore money flow from foreign institutional investors will be difficult? Why should somebody exercise that?
So I also agree with your point. My view is that there is no need to shift at this point of time. Particularly if you see the Axis and ICICI both have seen the management change. But we are going to see the change in management in HDFC over the next 2 years. So the current MD CEO's tenure will be ending at around 2020, and as per the RBI regulatory norm, I think nobody can hold the position above 70 years. In case if there is a change in regulatory and they increase
let's
age
assume
limit,
that doesn't happen.
so if that doesn't happen, then there will be a change in the management. And we have seen that past 2 decades, HDFC is one bank which has garnered higher investor participation and premium because of the management stability. The same person has been leading the bank since the inception.
Sure.
So there is a change in management, there will be some amount of disruption, but even though the bank has been existing for 2 decades and they have a good process, so there is a slight amount of changes will change the investor mood over there. And also a couple of business points, like we have seen HDFC's growing their portfolio at higher rate in their credit card plus their unsecured lending, so that's been growing at a higher rate. And if you look at the credit cost also, it's inching up year over year. So we have seen the loan growth is growing at a higher rate than the profit growth. So these are a couple of points, and we have to watch out for these points also. So I don't see any need at this point to switch over from the corporate facing to retail facing.
Okay. No, I'm just wondering if indeed HDFC Bank, the processes are so strong that they would really have instability even if there is a change of leadership. If Aditya is to move out, he'll probably ensure that the successor is somebody who is worthy enough and who will stay put and give that continuation of stability. So wonder if that point will work out or no, but I take on board your point. Maybe in the minds of people, if not actually, it could play up bearing as well. By the way, the Feb food article prices and some of those flashes up on your screen, I think the December wholesale prices or December inflation numbers also have been revised downwards. Mind you, yesterday or day before yesterday, the CPI and the IIP numbers came out as well. All of those factors would probably point to some rate action by the Reserve Bank in the policy up next, and maybe continuation of the dovish commentary, which might only help banks. But anyways, this is not a forum to discuss that. We'll do that later on. For now, the first discussion, time to switch or no. Senthil believes no. Other two experts believe that either in part or in full, you could actually switch, or even if you want to buy a fresh, go out for an HDFC Bank. Forum believes that's a better bet. Let's talk about the second stock, Just Dial. That's rallied about 30% in the last 3 months. More so, it rallied quite significantly in trade. Yesterday is up about 2% in trade today, trading at fresh 52-week highs. What's causing the rally? Will this continue? Senthil, let's start off with you this time. Rather, Sameer, let's start off with you this time.
So we own the stock. We own it since 420, 430.
Why did you buy it? And do you think it will continue?
Because the cash flows and the quarterly numbers give us no points to be raised on the negative side. And if you see, Just Dial has always these cycles where FIIs are the main pushers of the pricing, stock prices, let's say. When they start selling, Just Dial is the first victim of the whole selling. And when they start buying, Just Dial becomes, that tailwind hits Just Dial very quickly.
Interesting.
So that's why if you see last 3-4 sessions, the rally has just extended to a very big system. Over there, the liquidity is very controlled by FIIs. So even a smaller proportion coming down to Just Dial pushes the prices. I don't see any reason to sell off in these kind of rallies. And I see rally is there at least another 10 to 15%, because quarterly numbers are growing, their unique visitors are growing, their mobile contribution is increasing, which is helping them improve the margins. And there's cash on books around 700 crores. So that kind of a cash on books, there's no dilution of promoter. So there are no triggers where I can pinpoint that this is something wrong with the firm as of now. So I think the next couple of quarters will be important for them, and that will regain the investors' interest.
Okay, so Sameer has the stock and he's staying put with it, believes 10-15% upside more. Senthil, what about you?
So firstly, if you look at the listed internet startups like Just Dial or InfoEdge, I think we don't like the business model of Just Dial, because offering all-in-one as a package, because there is a lot of competition coming in from Google's plus the vertical focused apps. So that's one major reason for avoiding the stock. But as Sameer mentioned, I think if you look at the numbers wise, I think they are quite strong, because they have a net cash and they're doing buybacks, so capital returns coming for the shareholders. But every investor will, especially in the internet startup, they will look for a long term, at least for a 3-5 years range. There we don't see enough clarity from the business model as of now. And also, if you look at the recent measures they have taken, is they are going aggressively in the tier 2 and tier 3 markets. Because of that, I think the realizations will definitely impact. So the margins, either they will be able to at most manage at the current levels, or it may decrease further. So these are the 2 pain points, and we are just avoiding the stock as of now.
Okay, and Foram, it's interesting because they do have big daddies in that space. This one is a generalist and not a specialist. What's your view here? And if you are bullish, do you think that bullish view holds up to a particular level after which Just Dial doesn't merit a buy and hold?
I think the rally has just begun for Just Dial.
Just begun.
Yeah, because see, if we see the shareholding pattern, 40% of the shareholding is owned by the FIIs, and we are just listening to the FII data. They have just started coming from the month of February, so they're just they have just pumped in money, in a span of 2 months. And secondly, if we see the entire MSME and SME sector is now picking up, so the ad revenue spent, from these sector is going to be immense, and the listing, and that is why we are seeing a traffic increase, in the ad revenue space, in the campaign side, from MSME and SMEs increasing. Now this ad revenue is being increased through mobile, advertisements. Now if we see in the entire pie, with the desktop and mobile, I think mobile is contributing 78% of the total segment. So it's very easily feasible, and that is why I think because of the feasibility, we are gaining tractions, and that is why I think there is a long way to go. We had a lower base, the company did not grow earlier, and now of course Google is there, but through this search engine only, they've been able to catch up, in the eyes of the visitors, and that is why I think the rally would be sustainable. We would continue to see good set of numbers even in Q4, and I think management is also guided for a good and healthy FY20. So I think everything is fine. The ROI, the return on equities, and everything is improving. Cash on book is good. I think 1400 crores. As on Q3, out of which they've just done a buyback of I think 200 crores or something. So I think it's a very healthy balance sheet, and that is why Just Dial definitely augurs a good buy even at current market price.
Wow, but that's the nature of the business as well. I think the business like this throws up oodles of cash and doesn't require too much of cash to grow. It's similar to maybe businesses that used to be in the IT space or probably still are as well. The balance sheets are usually very, very favorable too. Interesting though, our experts out here, except for Senthil, I think experts out here are fairly bullish on Just Dial. On Saturday we had a BQ Edge event in Calcutta wherein the 2 experts out there were not bullish on Just Dial. So this is a stock like that. It kind of divides opinion out here too. I think the 2 stocks or the 2 pockets that we've discussed till now, there's a divided house. The experts to my left are in the same opinion, and the expert to my right is of a different opinion. Let's start that discussion with the expert to my right, and that's Senthil, and it's the defense PSU names. Is the right time to bet on stocks like BEL or BEML, and why or why not?
So we don't like the entire defense sector itself,
at all,
either be private or public.
Why
so? First reason is there is a single customer, government, and there is a risk of policy changes. So for example, last quarter we saw government reducing the margins on the nomination basis orders for the BEL. So being a single customer focused, I think there is a tremendous amount of risk with policy changes. Second point is the long-term nature of the contracts. So it takes for a single large contract, it takes decades for completion of the contracts. So this also involves large amount of risk, plus there is a large amount of patience from the investor side, because initial 3-4 years there won't be any income, and there will be a lot of spending on the expenses. So it's a capex intensity sector. So these are the couple of points on the business side we don't like. And if you look at the listed defense PSUs, I think mostly these are government owned entities where where the focus will be much on the how the government is going to utilize these assets, and what we are seeing in the government in oil and gas, other sectors, they are continuously reducing their stake, and government as a promoter hasn't created wealth in the long term, so we just avoid the space.
Okay, Tell me one of you is bullish on this space. That seems to be the pattern today. Foram, let's start with you.
Yeah, so I am bullish on the space.
Not unexpected. Tell me why.
So we do like, defense space, because if we see historically, H2 has always been better than H1. And, the kind of order pickup and execution and all, that is why H2 always tends to be on a growing side than, compared to H1. And if we look at BEML in particular, BEML has a very small segment, coming from the defense side. It has more of its revenues coming from the railways, from the mining sector, and even if we see the IIP numbers which have come yesterday, mining sector continues to keep growing, so that is why I feel that BEML, because it is into mining and even railway infrastructure activities we are seeing, it's picking up, and of course the order inflows that BEML keeps on getting it, so I feel that BEML augurs a good buy. And of course we can also see the improvement in the performance, quarterly performance have also started improving, unlike the case it was 1-2 years ago. So supported by good quarterly performance and good order inflows, and the macros of course which is supporting the company with regards to the capex and railways that we are seeing, mining, and defense is like a very small pie in the books. That is why I think I would continue to be bullish on BEML.
Okay. Samir, if at all there is a call, is it a tactical call more than a structural call? Because I think the one point that Senthil makes is right, that if you look at businesses that you want to buy and hold for the long term, there needs to be a few factors, all of which are missing in this business, right? Single customer, concentration, therefore receivables tend to come with a lag, subject to policy changes, all of that. That is a clear and present danger always. So even if you take on board Foram's point, and I think her point of BEML was separate because it's not necessarily only to defense, but the nature of the business. But defense PSUs, would you go out and buy them? And even if you're buying them, are they tactical calls more than fundamental calls?
So I think for everyone it's become more tactical calls. If you see even the defense orders, let's go 5 years back when the new government came in, there was a lot of talk of defense orders.
A lot of talk, yes.
Right? And the valuations just shifted upside, right? There was a lot of re-rating, whether it's BEML or any other name. So over there, if you see 5 years, nothing eventually incrementally has happened over there where it can push up. So my only point is it's more tactical. It goes more structural in terms of estimations. What happens over there, if you see L&T, let's figure out L&T, right? L&T has started defense, but they are restricting themselves to design and then to a certain extent the manufacturing part of it. Their margins are around 40% on the defense orders, which they are executing even today. Their receivables are not a problem. So for me, playing through L&T is the best option out here. In defense sector, whatever, BEML, though defense is not the main contributor of the system, but as you want to grow, the defense orders become the bigger chunk of the order book. That means it will become a bigger chunk of your receivables in next 2 to 3 years, even if the system starts to run up. So I think on the future end, there becomes a lot of receivables uncertainty. Because for me, the government is not the problem. For me, the receivables which get into that 120 kind of 120 180 days kind of a payment, and you don't have any cash business. See, all the businesses which BEML does is not that short receivables.
Sure.
So cash flow utilization is quite a lot even today without the defense orders. Now when the defense orders rack up, that cash flow outage becomes even further more. So for me as an investor, even if it's a structural story, I'll pick a company which has other cash flow sources.
Which is BEML.
Which is L&T.
Which is L&T.
L&T or a Bharat Forge for me, because they are restricting themselves to design and to some extent of component manufacturing.
But you're not buying them for the defense business per se. You're buying them for a lot of other reasons.
No, see, if you see the future, if you see even US or other countries, defense orders come in lag and they come in bigger terms.
Yeah, which I agree. But I'm asking whether you'll buy an L&T on Bharat Forge, even if you're buying them, you're not buying them for the defense business purely, right?
So not purely, yes.
Yeah.
But
is that the major driver, or the major driver is the other core business?
Next, other 4 businesses are the major driver, but this becomes like a complementary system to the whole thing.
Okay.
Because if I want to get exposed to that kind of a sector tomorrow, and L&T itself, because if the whole sector is growing at a very fast speed, I think private players will outplay PSUs. And just to make another point, BEML and others have restricted their margins on these kind of contracts. So that really, I don't want to enter into a company which restricts themselves that we won't earn much out of the contract. So that's where I figure out that it's better to play through private players than PSUs.
Okay. Fair call. And enough points to counter all of these points as well. But that's what makes the market, doesn't it? There's a buyer and seller for every stock. The buyer has strong reasons and the seller has equally strong reasons. So assuming both of them are fundamental, of course. So you can keep on arguing about this till the cows come home. Let's not do that. Let's argue about stocks and what can you bet on, because that's what everybody wants to know right now. And on that, Foram, let's start off with you. If you were to bet on one mid-cap name right now, what would that name be and why?
Yeah, so I'll bet on Aditya Birla Fashions Limited, ABFRL.
Why so?
Yeah, because we have seen it's one of the successful turnaround companies, and the brands, Pantaloons and Madura Fashions and all are growing very good. Earlier, if we see, Pantaloons was not contributing too much to the balance sheet, but now I think Pantaloons is also growing at 20-30% on a yearly basis, and the kind of turnaround they have done and the kind of segments that they are entering into is also very healthy, and the demand for apparels is of course ongoing, and that is why I think with the structural improvement in the company supported by a good demand, I think it augurs a very good buy. Of course, ABFRL I have recommended earlier also from the levels of 188, and it has given a good 25-30% returns from there on, but I feel that company has just started to grow, and there's a long way to go for this, and that is why I still feel that it can go up till 260 rupees. And I think everything is clean. They are cutting down on the debt, and segments are improving, demand is there, so I see no reason to not buy the stock even at current market price.
Okay. This stacks up well versus some of the other retail players, I mean retail or in that category, because there are a bunch of options available.
Yeah, we have Trent is there, but if we
now you have Arvind Fashions.
Arvind Fashions is also there, but I think the market share for ABFRL products, I think that is increasing.
But you like that versus, say for example, a pure play retailer like Shoppers Stop as well?
Yes, I do like it, because if
but you like AB Fashion more than Shoppers
Fashions
Stop?
More, yeah. Even I would say Arvind Fashions have just listed 2 days back, 2-3 days back. But I think this company has proved itself, from a loss-making company to an profit-making and increasing its market share. I think everything is on the right track. So if we see Arvind Fashions, we would have to still wait for the numbers. How does it pan out? And that is why I think someone who has proved himself, so we should go by them.
Okay. Mind you, even these guys are fighting the Big Daddy, but the Big Daddy has some very exclusive high-end brands, and therefore the competition landscape might be different. Reliance Retail has a completely different set of high-end premium brands, not necessarily the brands that maybe Arvind Fashions or Aditya Birla Fashion caters to. Sameer, one top name from your end.
So for me, this year is Oberoi Realty.
Why so?
First, if you see, it's cash on books. That's the only real estate firm right now who has cash on books, and that is also accordingly a net of 400 crores. And the debt is going lower quarter by quarter. So that is helping increase the cash on books. Second, they have two major projects, which is one is in Borivali. That is coming up to a 50% kind of a completion. So that is around 2500 crore kind of a project, which will hit revenues in next 6 to 9 months. So that gives a big boost, and the margins are around 30% on that. So that gives a very big leg up to the numbers in coming quarters. The other part, they have secured a 350 crore kind of annual rentals out of the commercial buildings they have as of date. That has increased from 200 crores as per last year. So that is a big boost to your cash flow generation on an annual basis. So I think all these factors which are there, and now when government is recognizing there are a lot of issues in the real estate end, and I feel in next 12 to 18 months there is a lot of RERA inventory which has to come up according to the compliances, and there a lot of middle players will go down. They will not be able to secure funds to complete that inventory, and the cash rich companies can gain out there.
Okay.
Whether it's a land buying opportunity or securing a property out of other developers. So I think Oberoi for me is a best place bet.
Better than Godrej as well.
Yeah, better than Godrej.
Better than Kolde Patil too.
Yeah, better than.
Okay. Great. Samir Kalra's top bet, Oberoi Realty. Senthil, what about you? Your top bet?
So we like all cargo logistics.
All cargo. That's
Yes.
your top mid-cap bet.
Yes.
Why so?
So the company operates in 3 business segments. The mainstay business is the MTO, where they do the less than container load and full container load. And here, if you look at the business, they make a margins of around ROC of upwards of 20%, and it's a cash flow generating business. But if you look at the other 2 segments, one is the container freight station, where the entire sector has gone into a kind of stress because of the change in government policy. Government has come up with a direct port delivery. So because of that policy, I think the container freight stations saw their capacity utilization coming down for the last 6-7 quarters. But now I think the regime is just started stabilizing, and there has been some news also, like government is looking to intake CFS operators also into this scheme. So this business is a highly high margin business. They make around 25 to 30% kind of margins in this business, and they opened a new CFS at Kolkata. So I think the volume growth should also come in. And the third business is their equipment leasing business. So this business also has gone to stress in the last 1.5 years because their main customer is wind energy players. So most of the wind energy players, because of the change in the auction regime, I think the entire installation has declined 50% year over year. But now this year, I think the auction has back on stream, and even some of the land issues are being sorted out. So once again, I think the last 2 quarters from a loss, I think they have break even. So I think with these 2 segments coming on to profitable, I think overall, I think the numbers should look in the next 1 to 2 years time frame. And valuations also very attractive. They trade at 10 times near forward earnings, and if you look at the balance sheet strength also, I think being a asset light business, I think they're one of the strong balance sheet companies in the logistics space.
Got it.
Yeah, that's the reason really.
Okay, so 3 good ideas. Not much room for debate, not much time for debate as well, because all 3 stocks have some promise to themselves. Well, but on that note, we are out of time at least. I request all our viewers to write into us what they thought of the ideas presented today as well on Hot Money. It will be interesting for us to learn from them as well. But Senthil, Foram, Samir, thank you so much for joining in today and giving us your thoughts. And viewers, thanks for tuning into this leg of Hot Money. Stay tuned though. Ask PQ is up next on Bloomberg Quint Live.